Hey everyone, welcome back to the IT Investor Podcast. Pramod Gudishetty here. Wally, how are you doing?
Man, I'm great. It's definitely been a busy week. Just getting back from time off in Canada. Spent five days up there on a little vacation, and
Yes.
just kind of getting back to it.
Yeah, I know. We were supposed to go to Canada for a marathon race. How was it?
Oh, it was a lot of fun. Like I said, I spent 5 days with four friends here from Arizona, and one of our investing partners up in Vancouver. He plans and puts it together every year. But yeah, it was a good race. I didn't hit the 100-mile mark goal that I had, but I had a pretty good run and had some fun with some friends. So it was a good
Uh,
time.
So, how many miles did you run and how much time did it take?
Yeah, just a little over 83 miles. The format that I was running
Wow.
in is called the last runner standing format. So there's no like set distance. This race could go on for days if runners will last that long. You run 4.16 miles every hour, and also within that hour, you need to kind of figure out, if you need to get some food, use the restroom, change your gear depending upon the change in the weather throughout the day. All of that needs to be figured out within that 1 hour, and then you have to be back to the starting line at the start of the next hour. And that's where a lot of folks kind of mess up, is you miss time things, or as the day wears on, you're running a little bit slower and you run out of time to get back to that starting line. So that's
Yeah.
what happened. This was my third attempt at a 100-miler. I'm going to do it again. So got to
So,
keep stabbing at those goals.
in 1 hour, how much distance do you need to run?
It's not I mean, it's a lot, but it's not a lot. It's 4.16 miles. I don't know why they picked that number, but that's how it works out. I think they picked that because in 24 hours that equals 100 miles.
Oh, okay. And you said you ran 80 miles. So that
A little over
means
80.
you ran continuously for about 20 hours or something like that? Or when did you
Minus
start and when did you end?
Yeah, minus the breaks when you get back to your own personal aid station. Started at 8 a.m. Friday morning and finished Saturday morning around.
Oh, wow. I
Yeah,
could never run so much distance. I might run probably say at the max 2 hours, I think.
yeah.
Anyways,
It's just
so
training.
while you were in Canada, I had some interesting time at work. So I got access to Databricks at my new project, and I noticed a very cool thing which I wanted to mention it to you. So while you're coding in Databricks, and when you try to run something and it errors out, and the good thing is they have added an AI component to Databricks. It would tell you what the error is and it would also fix the code.
Oh
And
wow.
with the press of the button, you could replace your code with the suggested code.
Oh cool.
Yeah, and it's like magic. It works. This really made our job easy, I think.
Yeah, maybe you're not ready to quit your 9 to 5 then just yet. Are you enjoying work again?
Well, we have to see, right? I mean, how
Yeah,
this all
sure.
goes. Yeah, yeah. Okay, anyways, having talked about Databricks and all that, today we want to talk about syndication, which we hear all the time. It's going to be a great learning episode for our viewers, I think. In this episode, we want to dive into what a syndication is, how they work, why they are one of the smartest ways to build wealth passively, and we also want to get into the pros and cons of it. So, having said that, what are your thoughts on it, Wally?
Yeah, I mean, why don't we just kind of dive into really what a syndication is? A real estate syndication is essentially it's just a group of investors that pull their money together to buy something big that they can't buy on their own, like we do, the apartment complexes. Average hold time for something like that, investors pull their money together and hold on and own a property for 3 to 7 years. You can kind of think of it almost like buying a giant pizza with a bunch of friends, but instead of sharing cheese and pepperoni, you're sharing those rent checks, and then at the end, the equity that's gained. Pramod, can you share maybe how the concept of syndications evolved?
Yeah, sure. Real estate syndication dates back to the early 1800s, but with the Jobs Act of 2012, it was a turning point and it allowed sponsors to publicly advertise these syndications, most especially with the power of internet and technology. These changes now made it easier for professionals like us to find and invest in deals, which earlier was limited to the old boys at the country club. Today, syndications are easily accessible, structured, and managed with the power of technology and internet. Syndications allow you to be a passive investor, leveraging the expertise of experienced operators, while traditional rentals require active involvement in tenant management, maintenance, and more. So, next time, if you are passing by a beautiful, big building or an apartment, it most likely is owned by a group of people. and some deals could have hundreds of people invested in it. Generally, people invest anywhere from $50,000 to 10 million.
Yeah. So, wow, 10 million. That's a lot. I'm not there yet, but 50K, I'm okay with. Someday.
Yes.
Um, why don't we break down the structure of a real estate syndication? Basically, in that structure, we have the general partner and limited partner. We've covered this in some previous episodes, so be sure to kind of go back and check those out if you want a deeper dive there. But in general, the GP partner is also considered the active investor, the GP partnership team. They're responsible for finding, analyzing properties, securing the financing for the acquisition. There's a group that is involved in the investor relations, raising the funds to actually acquire the property. Then you have your asset management team that's involved in the day-to-day operations. They're in control of the property management company, maybe general contractors that are involved in the capital improvements, things of that nature. But essentially that general partnership team, they do the heavy lifting, where the limited partner is also the passive investor. Their role is really, it's not active at all. They're not involved with the day-to-day operations. They provide capital for the acquisition, and in exchange for their capital, they receive passive income, which is typically in the form of a quarterly or a monthly distribution from the syndication. You get to share the profits of the cash flow. And in the end, when the holding period is over and the property sells, you get to share in the appreciation of the property.
Okay. Thank you, Wally. Now let's talk about the legal structure of syndications. As we know, syndications are regulated by SEC, or the Securities Exchange Commission. There are two common SEC exemptions, the 506B and the 506C. The SEC has created these rules to protect the less experienced investor from high-risk offerings. Before we dive deep into the structure, we need to understand who is an accredited investor and a non-accredited investor. So the SEC has described saying that an accredited investor is a person who has $200,000 a year income individually, or $300,000 with his spouse for the last 2 consecutive years, or if they have $1 million net worth excluding their primary residence. So if they satisfy any of these conditions, they are called accredited investor. And this group has more access to the deals. Now, on the other side, if you don't make at least $200,000 a year individually, or combine $300 with your spouse, or do not have $1 million net worth excluding your primary residence, then you are considered non-accredited. Most deals are offered through 506B or C. Now let's see what a 506B offering is. This is more of a private route. In this offering, you can accept both accredited and non-accredited investors. And the key important thing in this 506B offering is you need to have a pre-existing relationship. You cannot do any public advertising. So what it means is we are talking about the deals with our friends, colleagues, or people whom we have built rapport with. Now let's see what is a 506C offering. In this offering, you must be verified by a third party like CPA as an accredited investor. Or sometimes you could be accredited by a third-party verification service. The deals in this offerings are publicly marketed on social media platforms like YouTube, Facebook, Instagram, LinkedIn, and email blasts. And on the other hand, 506B is based on building relationship first.
Yeah, another point to make too is you can start your offering as a 506B, take care of all of your non-accredited investors, people that you already have that substantive relationship with, and then you can convert it to a 506C and then start to advertise to everybody, and that will protect you from any SEC violations. Kind of a cool trick that some syndicators do.
Yeah, that's cool.
So let's kind of take a dive into some of the advantages and disadvantages of a syndication. The biggest advantage is you get access to bigger deals, right? As a single investor by yourself, you can only afford what you can afford. As a member of a syndication, as a limited partner, you get access to large scale properties with pretty minimum investments, 50 to 100K. On top of that, income is passive. You're not hands-on. You invest your capital and you let the general partnership take care of the rest of the work. So you're not dealing with tenants, you're not dealing with property management headaches. You really are. You're hands off. You get to earn while focusing on your career, your family, hobbies, things like that. In a previous episode, we made a quote about your paycheck stops when you do but your rental income doesn't have to. You're always earning even while you're doing those other things in your life.
I like this part a lot.
Yeah. Yeah. Earning money while not working. That sounds great. Absolutely. Another cool part about the syndication is the ability to kind of diversify across different markets, different areas, right? You can take smaller pieces of your capital and invest in Phoenix or North Carolina or Pittsburgh or, whatever areas you find that fits your risk tolerance. Another great benefit of real estate syndications and just owning property in general is some of the tax benefits, right? You get to use depreciation expenses to reduce your taxable income once the property's been sold and you have that big lump sum where you get that income at the end of the holding period. You can make a lot of that income disappear through the cost segregation and depreciation. Let's see. Yeah, another advantage of the real estate syndication is typically stronger returns. Syndications will target value add multifamily properties. We're aiming for properties where there's a lot of upside. We'll call it equity upside, right? It may be an apartment building that the whole complex is maybe we'll call it classic, like a classic standard. The apartments have not been upgraded yet, and you get the chance to come in or the general partnership gets a chance to come in, improve the property, maybe raise those rents to whatever the market rent is. And when you raise rents, you increase the operating income, and that raises the equity of the value of the property. Typically, the multifamily real estate or just real estate in general has outperformed stock market. Real estate typically, we can't guarantee returns, but you'll look at the last 5 years of an investment and you can see return on your investment in that 2x multiplier versus a lot of stock market options or a lot of stocks usually only provide that 10% annual return, and that's before inflation, right? So some of the downsides to a syndication, there's that lack of liquidity. Your capital is typically tied up for several years. Whatever that holding period is, 3 to 5 to 7 years, your money's locked up until the general partnership team makes that informed best decision to sell the property or refinance and pay back capital, whatever the exit strategy is. But your capital is not liquid. And additionally, as that passive investor, you do have limited control in the operations. You really are kind of that silent investor. Pramod, do you want to share some of the common misconceptions around a real estate syndication?
Yeah, sure. I can go through some of the general common misconceptions. So the first one is most of the investors or people assume they need to manage the tenants to be a real estate investor, which is not. The general team or the general partners, they do the grunt work. Many assume large real estate deals are high risk, but in reality, syndications are backed by tangible assets, and with the right sponsor and conservative underwriting, all the risks are mitigated, and the reserves protect for any rehabs or any unforeseen expenses. The third misconception is you don't need millions. Most syndications have a minimum investment of 50,000 or 100,000, as you have mentioned, Wally. And the only barrier I see is the investor needs to be accredited. Some complain about control, but it comes with the cost, right? Syndications are meant to be passive. You trade control for expertise of the general partner or the sponsor, and in return, you get the time and freedom, and you leverage experienced operators.
Yeah, so let's summarize why real estate syndications work. Syndications work for me specifically and for a lot of tech workers because they truly are passive. They offer strong returns. The tax benefits, so it's a very tax efficient investment asset class. They're tailored for high income earners like ourselves, tech professionals. You're backed by a real asset, scalable and strategic.
So, Wally, can you talk about vetting the syndication operator?
Yeah, definitely. Due diligence is paramount when you're vetting your syndicator. You want to invest in that syndicator's background. You could find your syndicators most often. You can look them up, the individual general partners on social media platforms like LinkedIn. They should have an established website. You can reach out directly to members of that general partnership team and ask for the schedule of the real estate owned. A lot of times they'll have that information on their websites. It's a good idea to ask for references from some of their current LPs. Get a reference and reach out to an LP and ask about how their experience has been with that syndication. And it's also good to review past performance. Obviously, past performance won't always predict future performance, but you get a good idea. Ask questions, right? No deal is going to go perfect. A really good question to ask a general partner when you're investigating a syndication is ask them about some of those tough deals that they've had to overcome some obstacle. If they've had a deal that's gone bad, how did they handle it? How did they protect their investors? Do your due diligence. I think also it's really good to understand communication style. right? So, and make sure it matches yours. Some investors like to have constant, monthly updates. How are things going at the property? What's the construction team working on? Things of that nature. And then some investors, they're fine with just handing over capital and waiting for checks to roll through. Just make sure you find a syndicator that matches your expectations. Those are probably the most important ways to vet who you decide to syndicate with. Speaking of seasoned syndicators now, Pramod, I know you've closed a deal not too long ago. Can you walk us through your syndication, your last deal?
Yeah, sure, Wally. So last year we closed on a property in Pittsburgh. It's almost coming close to its anniversary. So it was May 10th or 11th, I believe. So let me walk you through how we syndicated this deal. So as you know, Wally, to purchase any property, we really need to source the deal, right? Generally, we source the deals through emails or through phones from real estate agents, right? So it was late 2023, where around November, December, while I was analyzing multiple deals, and this deal actually caught my eye. It caught my eye because it was in a good location. The building appeared fairly new, and most units were rehabbed. So, since it gained my interest, I digged a little deeper into that. I did the analysis. I requested the agent for the rent roll for the 12 months of expenses, their tax documents, and utility bills. It checked my box for the realistic and the conservative underwriting approach. And once after it passed this criteria, we did a video tour of the property with the agent. He was kind enough to walk through the property and a few units, I will say. And later on, based upon the condition of the property with some minor damages, I further negotiated the deal. He accepted it and he asked me to put the number and send it their way through an LOI. So we submitted the LOI and it got accepted, say in about 2 or 3 days. So the important thing is once the LOI has been accepted, your clock starts because in the acceptance they give us like a 45 to 60-day period depending upon what you negotiate. Generally it is 45-day period, and this period is very crucial because in this period you do need to complete your due diligence, and after the 45-day period is completed you go to closing on the property. So now let's see, during this due diligence period there is a lot of steps that needs to be done, and time is of importance, right? So you should not waste any time. So right from day one, what I did was I immediately checked up on the internet for some local property inspectors and hired an inspector to inspect the whole building for plumbing, roof, electrical, HVAC, and structural integrity. Of course, this doesn't happen if the property is big. Sometimes this inspection can take multiple days because the inspector needs to walk into each and every unit. He needs to go into the basement. He needs to climb the roof, wherever, it's the whole property walkthrough. So, and the good thing is you can also walk with him to check on all of these, but he will definitely give you a report, say after a week, a good report with all the deficiencies where the property needs maintenance or what is wrong. It's very vast and detail oriented. It would be some hundreds of pages. Okay. Now, after that inspection is done, or parallelly, you could verify the rent roll, you could verify the T12, you could verify the utility bills, the tax records. You can do all those verifications. Now, since you have walked, let's say like if you have got the report back from the inspector, depending upon the condition of the property, you can estimate what the renovation cost would be so that you can further negotiate. And during this time, you need to validate what are the rent comps, how your neighbors or neighboring buildings are being rented for, what are the market rents. And in parallel, again, you would need to hire a real estate attorney to perform the title title check, the zoning, and also there is also an and again, you need to shop for insurance. Yeah. And I will say, and one more time, you also do need to shop for financing, which is the critical step, right? So you need to talk to multiple lenders, what type of loan you want to get, whether it's a conventional loan or a VA loan, and what are the terms and conditions. In our case, we went with a conventional loan with a local credit bank because they gave us, I think, first 1 year with no principal, only interest only loan. So that was good, I thought. So meanwhile, you do need to, if all that sounds good, you do need to think about raising the capital for this syndication, right? Because if you don't have the capital, you cannot close. Get all the inspection reports, do the due diligence, get the financing in place, and now you go back and put all this information and create a nice pitch deck so that you can present it to your investors. So grab some time and host a webinar with them and answer all their questions, and also probably educate some of your investors because some of them could be new to this deal process. After doing that, collect their soft commits. And always you do need to raise more capital because you never know in the last minute who might back out, right? Yeah. And as you're working, you do need to work with your real estate attorney or lawyer to set up an LLC, determine the splits, whether is it 70-30 or 80-20, determine your preferred returns, how much you're going to give it to your investors, and determine the fees. And simultaneously, the attorney would be asking you lots of questions as he is preparing the operating agreement, the subscription document, and the private placement or PPM document. So all these steps in parallel will be happening. You do need to track all these steps. And as you come closer to the deal, just a week before or 10 days before, you ask all the investors to wire the money because you don't want to have any surprises, say 1 day or 2 day, and you are short of, say, $1,000 or something, right? You don't want to be in that state.
Sure.
And in my case, I asked all my investors something like 10 days ahead. And luckily, by the close date, we were good and we had a good closing.
That's great. I'm doing some math in my head right now, and it sounded like December 2023 to May. That was a full 6-month process. There's a lot of work that's involved there to put that deal together, and some upfront expenses to, for the general partnership team to kick in and get it done. So congrats on that. That's exciting.
Yeah, thank you. And once after the LOA has been accepted, we, I think, asked for a 60-month period instead of the regular 45-day. So that gives us cushion. And also, it's always better to ask more time.
Sure.
Yeah, but sometimes some sellers could be hard. But I would say 45 days or 30 days is also good enough time, provided if you are on track and if you have the schedule of things to do. So having said that, now this wraps up our exploration of real estate syndications. We hope this episode has provided valuable insights to help you navigate your investment journey. Now, if you are ready to make your money work over time, here is how. Subscribe to our IT Investor Podcast or join our newsletter, connect with us on LinkedIn.
Yeah, your W-2 income can be that launch pad, and the syndication in a real estate investment can be the rocket fuel.
From code to cash flow, we are here to guide the way.
Okay, catch you next time. And remember, don't just scale your apps, scale your wealth.
Thank you.